What's up, everyone? It's Scotty with Money Vesting. So we've got a full-blown political theater on our hands right now with respect to the U.S. government debt. So much so that Janet Yellen pretty much came out literally today, this morning, and she said that it would be, quote, unthinkable for the U.S. to default on its debt. So I want to break down exactly where we are and what the consequences might end up looking like. Eventually, at the end of the day, we know exactly where we're headed. But how we get there is going to be a very, very bumpy road. And the reason I say that is because we're going to find a lot of back and forth here and a lot of indecision until it's absolutely necessary. Like, it's literally going to come down to the last hour until it gets approved and the debt ceiling is either raised or suspended altogether. So again, hope you guys enjoyed this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. The link to our Discord and Patreon is going to be down below. That 16% annual discount is available, so you can access that with a link down below, and of course get access to all the other alerts and private live streams and private benefits, and everything's included. So link's going to be down below. So here we are with the U.S. debt, of course, sitting at over almost $32 trillion worth of debt. And of course, the gray areas in this are the debt ceilings every time it's been suspended. And I think that's more recently, post 2010, we've seen more times the debt ceiling suspended as opposed to any time in the past. So I think that's really what it's going to come down to at the end of the day, where the debt ceiling is eventually going to get suspended. And then we're going to see, once again, the Treasury Department kind of work in a normal setting. But right now, as it stands, defaulting on the sovereign debt would wreak a havoc on the economy and royal markets around the world. And a default on Treasury bonds could throw the U.S. economy into a tailspin, something that we have talked about and we don't want to even imagine because it will be catastrophic for both the markets and the economy. So the last time we came very, very close to default was in 2011. That's when S&P also downgraded the U.S. credit rating from AAA down to AA+. And if the U.S. were to default, the GDP would drop 4% and 7 million workers would lose their jobs, as Moody Analytics recently projected. Even a brief default would lead to loss of 2 million jobs according to the data. So it's possible that we do see unemployment rate start to take back higher and the probability of recession increases if, of course, this becomes a more realistic scenario. In that scenario, the U.S. bond ratings will be classified as restricted default according to Fitch Ratings, and the Treasury would have a D rating until the U.S. could once again borrow. The Brookings Institution noted that default could lead to $750 billion in higher federal borrowing cost over the next decade because the interest rate is going to be higher because of the risk it's now starting to carry. Right now, we're already up to $1 trillion in interest on the debt, not the debt itself, but interest on the debt, $1 trillion. And what's more, a default would shake the U.S. position on the world stage, and U.S. Director of National Intelligence Avril Haines told Senate Intelligence Committee last week that Russia and China will take advantage of the U.S. potentially defaulting on its debt and the chaos within the United States that we're not capable of functioning as a democracy. And there will be chaos because there's a lot of payments that are scheduled, right? I mean, every single month, every single week, we've got payments from the U.S. Treasury Department out to other government offices and even lots of governmental programs as well. So if the U.S. were to default, it would mean a pause on tens of billions of dollars in payments. And the Bipartisan Policy Center estimates the first half of June. By the way, June 1st is the X date, is what we're looking at, the extraordinary measures. I think Janet Yellen's already sent out several letters talking about how the first week of June is when we're going to pretty much run out of the actual available credit limit. And then, of course, we're going to tap onto that debt ceiling. And eventually, of course, there's going to be government shutdowns and the payments will stop. But $50 billion in Social Security benefits are set to be dispersed, $20 billion in Medicaid, $12 billion in veterans benefits, $6 billion in federal salaries, and $1 billion in SNAP benefits. And in an interview on Monday, Yellen pretty much mentioned that, quote, "There are no good options. Every option is a bad option. I really don't want to get into discussing them and ranking them because every Treasury Secretary has known the only option that really leaves our economy and our financial system in good shape is raising the debt ceiling and making it clear that Congress stands behind the basic principle that America pays its bills." Now, this is a really, really tough situation because we're dealing with something like the single point of failure. Everything is dependent on this one thing. If this one thing breaks, doesn't work, or is not fixed, well, there we go, tough luck. And that's the single point of failure that I'm talking about. If everything's dependent on this one thing, then situation really has a very, very weak foundation, so to speak. So it's not today, it's not tomorrow, it's not June, but at some point in the future, this is going to be a bigger and bigger problem. And it's just like, in my opinion, at least, as I've mentioned before, and as Warren Buffett was also very unsure about the debt limit, the debt ceiling, the money printing that's constantly going on every single year with the fiscal deficit. It's just really, we're kicking the can down the road every single year. And I really don't want to be saying these things, but it kind of starts to feel a lot like a ticking time bomb, right? Eventually, someone's going to be ended up holding the bag, and what's going to be the consequences of that. So, these are some things that we have to obviously talk about. And how can the Congress reach a deal? So many analysts expect a short-term extension to give Congress more time to reach a deal. Others are floating more radical ideas like minting a $1 trillion coin to pay the debt, or urging the president to declare, that respecting government debt is a constitutional requirement. But either way, we are going to see a potential re-rating, because 2011, so again, 12 years ago, we were very, very close to defaulting on that debt, and the spending cuts were announced just hours before the deadline. And even delays had consequences, because we did have a U.S. credit rating come down from AAA to AA+, and the stock market's also plunged, and it's estimated to have cost the public at least $1.3 billion in higher borrowing cost in that year alone. So these are some things to definitely pay attention to, because right now, as much as it feel like political theater, it might really be, because at the end of the day, we know that the government's going to either raise the debt ceiling or suspend it altogether. It's still going to have some collateral damage, right? It's still going to have some external consequences if we continue to delay this process. So let me know your thoughts down in the comment section below. The markets right now are still somewhat irresponsive of this idea, but the treasury market definitely is responding to it, because we did see the bond market kind of rally higher. 10-year, 20-year, 30-year treasuries have been pushing higher, especially short-term bonds. If you take a look at 3 month, 6 month, 1 year, they're back up to 4.5%, 5%, 5.2%, 5.4%, because they're perceived as more risk now compared to some of the more longer duration bonds. So that's where we are. Make sure that you drop a like and subscribe to the channel. The markets, as we get closer to that date, could have some reaction to this potential news, whether we get a raise or a suspension or nothing. I think we're definitely going to see some reaction as we get closer to that date, but it's really going to come down to whether we get a credit rating, re-rating from those rating agencies or not. So hope you guys enjoyed this video, find it helpful. Make sure that you drop a like, subscribe to the channel. Let me know your thoughts down in the comment section below with the debt ceiling and where we are in the process. And as always, happy investing, and I'll see you all in the next video.